Hello friends, this is Raj Sastry from Raj Option Trading. Today is November 21, 2021. Let's talk about Lemonade, ticker symbol LMND. So they're into insurance and they want to disrupt the insurance business here. They want to be the Netflix of insurance business here. So they want you to forget about insurance, whatever you know about insurance, because they are this cutting edge digital artificial intelligence play here. So let's look at this company here and see if we can buy Lemonade. Let's jump in here. So Lemonade also acquired a company called Metromile that will give them very good advantage as they go into car insurance or automobile insurance. Let's jump in and get started. As you look through here, you look at the company overview, look at the major ETFs holding Lemonade, look at the competitive landscape, review a few charts, do a deep dive on Lemonade, and look at the financial summary and stock performance, and then do a final verdict. So with that, let's jump in. So you might wonder, why should I buy Lemonade? As you look through here, Lemonade wants to disrupt traditional insurance industry using the behavior, artificial intelligence, and machine learning. And they want to become the Netflix of this insurance industry and get rid of the old traditional way of insurance. And they also want to reduce the paperwork. It's very, when you go to traditional insurance companies, you get to do a lot of paperwork, whereas here it's an instant approval. Just a few clicks and you're done. And they also want to donate the funds to charity of your choice. If there is some more money left after the claims, they will let you donate that money to charity of your choice. That's a great one here. A lot of folks want to donate to the right cause. This is a very good way of incentivizing customers to buy Lemonade. So with that, let's jump in here and get started. You might wonder, what do they do? So they are into renters insurance, home ownership insurance, car insurance, and pet care. And if you bundle multiple of these things, you'll get nice discount and amazing savings. And everything is very low or incredible price, monthly subscription. So that's the advantage here. Very easy to go in and buy insurance, few clicks away, and very good price. That's why most people want to go into Lemonade, and that's why this company is growing top line nicely. So with that, as you look through here, there are a lot of customers who are switching from traditional insurance company to Lemonade. We got here Assurant, Farmers, Homesite. Multiple of these companies are switching to Lemonade 31% of the time. Then we got Allstate, nice switching here to Lemonade, and Liberty Mutual, State Farm, Travelers, Geico. The shift has started. Most folks understood that traditional insurance companies are not doing the job right. They want to go toward the digital artificial intelligence enabled company, which also provides money to charity of their choice. With that, it looks like a great choice here, and they got some initial trouble to really get it started. They're growing their top line nicely, but bottom line they have to improve. So with that, let's jump in here and look at this company. As you look through here, Lemonade provides various insurance products in United States and Europe, and they got products to cover stolen, damaged property, personal liability, and so on and so forth. And they also operate as an agent, for other insurance companies. Overall, I think their platform with the artificial intelligence, machine learning, behavioral sciences are the key here. So using those technology savvy nature, they want to disrupt the traditional insurance industry. So with the stock price is around $52, market cap is around $3.25 billion. Still a small company, and they want to grow nicely. As you look through here, this is a 1-year-old company or so. Stock price has been going up and down a little bit, but gradually it's a drift down, as you can see here. The company is making some strides here, growing the top line nicely. Think about old days, Amazon.com when it started. Basically the revenue was nice, top line growth was good, but bottom line, when it comes to margin and income, that was not there. This company is something similar right now. They're growing their top line nicely, but bottom line when it comes to the actual income, that's not there yet. So I think it's an early stage company. Many of these early stage companies tend to do a good job with the top line growth. I think this is same story here. As you look through from an analyst perspective, there is a moderate buy here. Three analysts saying buy and two hold. So that's why it's a moderate buy. I think that's a very good grade for this company. We should moderately buy here, given the stock is down and they've got great ambitions as we go forward. And this is one of the disruptive tech stocks here. They can supercharge your portfolio. And we have one more comment here. There is a AI-based insurance stock that is not Lemonade. We'll look at this one also. And folks are saying we should double down on Lemonade. That's a good one here. And they also have artificial intelligence, which can really turn the corner and effectively compete against the traditional insurance players. So with that overall, the company checks out here. They're doing the right thing with the AI and machine learning based algorithms. So with that, let's look at the leadership here. We got Mr. Daniel, who is a co-founder and CEO at the top. And look here, there is a great review from Glassdoor, 95% approved CEO, and we got 214 ratings here. This is one of the best ratings I've seen in the industry here. I think he's doing something right, and the employees are approving him. That's always a good one. And as you look through his previous work here, he's a co-founder and CEO. That's a good thing here. I like to see co-founder or founders at the top. And he was also a serial entrepreneur. As you see here, he was in the board of directors for PowerMat, and he also started various companies, as you can see here. So that he's not new to this starting the company and co-founding the company. So that's why I think he has got nice skills to offer here, and he can lead the company very well. So with that, let's jump in here and get started. So as you look through here, there are a lot of these big ETF companies buying Lemonade here. Look, we got Vanguard Total Stock Market here. They're buying 57 million shares of this company here. And we got a lot of these ETFs holding a good chunk of Lemonade stock here. So everybody knows this insurance industry is ripe for a disruption here, and they know Lemonade can get it done. That's why even though stock is down, all these ETFs are holding nice chunk of Lemonade stock here, waiting for a nice rebound as you go forward. As you look through here from a competitive landscape perspective, we got a lot of traditional insurance players here, and then you got Lemonade. So look here on the top, you got CCC Intelligence here. This is also in the pure software space. They also have artificial intelligence, machine learning based algorithms, and the stock has been doing very nicely, as you can see here. I love CCCS here. Right now, I think it's good to wait for a little pullback. RSI 69, so that tells you it's a little hot here, but I would slowly buy as they pull back a little bit. This company also do very well. And then you got your AFG here, which is the American AFG company here. As you look through here, this has done nicely, 157% in 5 years and 97% in 1 year. You can buy this one also in a pullback. RSI is 69 right now, a little high for me. And you got few more as you can scan through here. Focus on low RSI candidates like CINF. PRA is a good one here. ProAssurance here, just $23 stock here. You could buy that one too. Loews is a good one also. Right now, I think there is no sales growth when it comes to quarter over quarter, but still a good company to buy. And I love Chubb. Chubb is a gold standard in this industry. They're doing great. And this company also has done around 29% in 1 year. It's good to buy Chubb on a down tick here. Right now, RSI is a little high for me. And then you got a few more here, SIGI, MRCY. Keep watching the sales growth and gross margin. Many of these companies have got nice sales growth. I think all those companies with nice sales growth and low RSI are the great candidates to buy. And as you scan through here, the company that we'll talk about, Lemonade, right here, stuck in bottom here. Look, nice top line growth here, 101% quarter over quarter. They know how to grow top line revenue. That's why it is doing nicely. But net margin perspective, it's not there yet because they're not focused on the profitability yet. They want to grow the business and disrupt the traditional industry. That's why their top line growth is superb, but margin is not, net margin is negative still, which is by choice. RSI is very, very, very low here, 33. That's why you should buy at these levels and take it from there. And as you scan through here, we got few more players at the bottom here. Even Camphor is also okay here. They got a little bit revenue growth here, not as much as Lemonade here. If you watch this list here, who has the most quarter over quarter sales growth? That's Lemonade, 101%. So that's why these folks want to grow the top line growth here, top line revenue, and they're not worried too much about net margin yet. But as I told you earlier, I also love CCCS here, pure software play. You could buy this one also as it comes down a little bit and accumulate that one too. So with that, let's jump in and get started. So as you look through here, we got few companies here. We got CCCS, pure software play. Company doing very well. I would recommend buying this one as it pulls back a little bit. Great stock. Look here, nice on balance volume that tells you folks are buying into CCCS here. And then you got Lemonade. Lemonade, as you can see here, stock has been drifting lower a little bit. After the announcement of Metromile acquisition, it came a little more down here. On the balance volume is also pointing downwards. I would take advantage of this situation. Chart is ugly. You could buy some Lemonade and position yourself for a longer term bounce back here. And then you got PRA here. PRA is also good here. ProAssurance, as you can see here. Nice looking chart here. Right now a little bit down, as you can see here. RSI is just 50 and nice on balance volume, pretty steady here. You could buy some PRA also here and take it from there. And then you got Loews here. It's not the retail company, home improvement company, but it's the insurance company, ticker symbol L. As you see here, nice looking chart here. Right now RSI is 49, so you could buy this one. This company, makes money, net margin positive company, just like the other two on the top here. You could buy some Loews into this downtick a little bit and accumulate. This is also a good one. So in summary, Lemonade is a disruptor here. Even though chart looks ugly right now, they got a lot of potential. This can be a multi-bagger as we go forward. So with that, let's jump in and look at Lemonade into a little more detail. As you look at the snapshot here, we got Lemonade, and right now analysts are saying hold or moderate buy depending on which data you look at. Right now it's at between hold and moderate buy. And as you look through, their earnings just happened earlier last week here. And as you scan through here, they just did an IPO just in 7/2/2020, just 1 year or so old company here. Stock price is $52. Market cap is $3.2 billion here. And as you see here, they've lost so much in 52 weeks here. They're down 71% from 52-week high here. And they're even below their 52-week low here. That's why it's a compelling opportunity right now to slowly accumulate and buy. And they got a lot of short ratio, as you can see here. A lot of these short sellers are breathing down its neck here. That's why they bring out some good news here. Company stock can go higher. And they also have a little bit from a float perspective, they don't have too much float. It's a very low float here. That's why on any good news, this stock can squeeze those short sellers and go higher. As you look through here, they got nice volume here. That's a good one here, and volume is higher. It's an unusually high volume, mainly because stock came down. Volume is 1.5 times higher than monthly, average 3-month volume. As you look through here, we got nice sales, 108 million, as you can see here. Look at the sales growth, very good sales growth here. They know how to grow top line growth here, and they're also doing good on the year-over-year growth here. But net margin is a different story here. They got EBITDA margin is negative, as you can see here. They're not focused on profitability at this time. From a price to sales perspective, it's a little pricey, but I think it's manageable. And as you see here, earnings per EPS growth is negative right now. Company is not expecting to make money right now. RSI is super low. That's why I think it's a good one to buy at these levels here. And as you look through here from a financial perspective, they have nice cash here, $1.1 billion cash. They can be solvent for a long time here. No issue around the company going out of running out of money. As you look through here, right now they don't have any very low debt here. Debt to equity ratio is very low here. Total debt is none. So that's a good story. I love companies which are not taking too much debt. This is one of them. And as you look through here, from a return perspective or a performance perspective, it's a negative all across the board right now. Even if you look at 1 year, it's negative. So that's why I think it's good to slowly buy into this situation here. Given stock is a company is a disruptor. Right now, they're not getting enough love from Wall Street. It's good to slowly buy and accumulate. And as you look through here, we got Lemonade from a earnings per share perspective. It's a negative trending down. Company is not focused on the earnings yet, which is understandable for these early stage companies. And from a sales perspective, look here, nice top line growth. I love this top line growth. Companies focusing on the top line revenue growth. They're acquiring new customers. A lot of customers are switching from traditional insurance players into Lemonade here. That's why there's a nice sales growth here. I love to see this type of sales growth in a lot of the companies. And then we got your shares outstanding. It's also trending the way I like it. I like the shares outstanding to come down here. That's the way to go. I think this company is really reducing the shares outstanding. I love that. And as you look through here from a quarterly revenue perspective, nice clip here. Look here, nice clip here. I like quarter over quarter revenue increase here. They're doing nicely here. And from a quarterly expense perspective, expense is also rising, as you can see here. I like them to improve this situation a little bit and see if they can reduce the expense a little bit down. But early stage companies, they got to advertise, they got to spend on their own R&D, which is understandable. I'm okay if they grow the top line nicely. It's okay to have some expense here, given they want to really do well as a company and compete effectively. And as you look at quarterly income here, that's trending down here. They're not focused on the income yet. They're focused on the top line growth. That's why you see top line growth increasing. Expenses or net income is reducing a little bit, which is okay for these type of early stage companies. Amazon.com has done this for long time before they became profitable. I think this is okay for early stage companies and for disruptor like Lemonade. So with that, let's jump in here and look at Lemonade into a little more detail. As you see here, we got Lemonade from a market cap perspective. It was a $2 billion company back in 2020. Now it's back in 930, it's a $4 billion company, and right now it's a $3 billion company. So you can see slowly companies growing their market cap. That tells you companies are really taking the market share away from other companies. From a stock price perspective, it is a $49 stock here, became $67 stock. Look, it also went much higher, and right now it's around $52 stock here. Pretty up and down type stock here, but I think it's a good one to buy here at these levels here and hold it for a long time. And as you look through your sales, I love this top line growth increase here. 18 back in 930 2020, now it's 36 million. So companies growing their top line, that's always good. From a quarter over quarter sales growth perspective, it's 100%. That's also great. Company doing nicely here, even though it's off of a lower number here, but still it's doing well. And as you scan through here, we got cash here. Nice $1.1 billion cash here. Cash decreased a little bit, not a major concern yet. We'll see how it trends as we go forward. But they got a lot of money. They're not going to run out of cash anytime soon. As you look through here from a free cash flow perspective, it's negative right now. I want them to improve this situation here. I like to see free cash flow improving. Right now it's decreasing, so I like to see them change this situation here. And from a margin perspective, the company is not there yet. They're not focused on the income and margins right now, which may be okay for these type of companies which are too early stage. And from a ROA and ROE perspective, it's negative. I typically like to see this in double digits, but this company will take some time to provide double digit ROA and ROE. And finally, price per sales. Valuation came down here. Right now it's 37, a little bit high, but I think it's manageable at these levels here. Overall, in a nutshell, company is growing the top line nicely here, and they are not too much focused on the bottom line or the margins yet and the earnings. I think as they go forward, they should focus there also. Look, they got high short ratio here. Any good news stock can go higher, and the stock is down 17% in 1 year. I think it could be good to slowly buy and accumulate and hold this stock here. And if you look through the quarterly earning report here, when they announced back in November 9th, which is just last week, they beat by 7 cents. That's good. And they also beat the revenue by 2.18 million. That's also good. I think overall they did good from a earnings per share perspective and revenue perspective. And they also announced acquisition of Metromile. I think whenever you announce the acquisition, Wall Street sometimes has got this sour reaction. That's why stock came down here. They're worried about, hey, you know what? Now you got one more company to manage, which is Metromile. The Wall Street is worried about the acquisition integration and the challenges that that might cause. That's why stock came down after the announcement. I think it could be a compelling opportunity right now. And from a revenue perspective, looks like they have nice 50 million net change in IFP. It's the insurance term here, in force premium here. That tells you they got current paying customers, drove nice revenue here. That's always good here. They have these existing customers who are paying more, who are bundling into other categories. That's always good. And they had a nice quarter here, as you can see here. And they grew by the premium, in-force premium grew by 84%. That's a good number here. They're growing their insurance here, premium here. And premium per customer also increased nicely here, 26%. And non-rental share of the business also ticking nicely here, for up to 47% from 44%. And as you know, in the insurance industry, folks want to bundle. If you have a car insurance and home insurance, you get a better rate. And by the way, if you also want to buy a pet insurance, you'll even get a better rate. That's why this bundling behavior is growing very well, with this company giving a lot of these bundling opportunities. Customers are taking it, and that's also helping the company here. And as you see here, they recognize the record volume of cross sales. That's very good here. Positive news. And they also, on the bottom line perspective, they also have some loss here. Loss was up 77% from 72. I think they have to focus on this situation as we go forward. Not a huge concern right now, but Wall Street will look at the bottom line, and that's why it's not there yet. This is one of the reasons stock is getting dinged, in addition to their Metromile acquisition. Overall, they're expecting some 380 million to 384 million for a full year. I think it's pretty much okay here. We'll see how it goes. They were doing about let's see here, 346 million, I think, prior year here. Now they're saying 380, which is okay. I think they will. It's kind of sort of inline type expectation here. We'll see how it goes. And then as you look through here from an earnings history here, look here, we got a nice earning beat here from an earnings per share perspective and revenue perspective. And the company has got they have missed their EPS couple of times, as you can see here. So it's a hit and miss type company here. Not very predictable, but only predictable thing is they're growing the top line nicely. That's always predictable. They always do good job here. On the on the earnings perspective, they're a hit and miss type company here. If they do couple quarters nicely with both EPS growth as well as revenue growth, the stock can explode higher. They're doing nicely on the revenue side. They do good on the earnings per share side. So with that, let's jump in here and look at the insider transactions. As you look here in a nutshell, insiders are selling a lot of the shares. See here, insider transactions minus 62%. This is a little bit a concern for me. I like to see this number go down, but I understand insiders sell from time to time for various reasons. Look, we got a nice $1.2 million sale here from from CFO here, and we got $54 million sale back in June here from one of the director. So that's a little high for me. Not a huge alarm. I've seen much higher numbers here, but we'll keep a close eye on this and go forward. And as you look through here, let's look at the performance over the years. I always want to look at the performance and see what's in store for the future. As you look through here, 2020, that's when they became IPO, nice 110% performance. 2021 so far not great here, down 56%. We will see how it goes if the situation improves, but overall right now it could be a good time. Given the company doing good on the revenue growth side, it could be good to slowly buy this company. As you look through from a monthly performance perspective, last few months are nothing but down for this company. So stock tumbled big time in July, August, September, October, November. I think at this time, after the earnings announcement, we could be a little more clearer, and even the acquisition announcement is done. I think it may be okay to slowly jump in and slowly accumulate this company here. As you look through from a weekly performance perspective, more red than green here. I think this 17% drop is because of earnings as well as Metromile acquisition news here. I think it's okay to slowly jump in and start acquiring. And as you look through here from a weekly daily performance, more red than green here. See here, it's trying to consolidate. It's improving a little bit. 6% drop continuously. Now it's 2% drop. I think at this time it may be okay to slowly start buying this company and sock it away. From a technical perspective, look at the chart. Chart is ugly. It's kind of lower lows as you can see here, and RSI is also trending down. It's trying to inch up as you can see here, but right now it's down. From a implied wall perspective, IV percentile is 30%. You could still buy some long-term call options here without paying too much money. Maybe say 90 days or 1 year out. That's a good choice all the time. And from a DMI perspective, directional indication perspective, the red line on top, blue line on the bottom, distance is pretty significant. That tells you right now it's a it's a bearish type play here. Chart is ugly. I want to see the situation reverse a little bit. I always love to see the blue line on top here, but right now chart is ugly. There's a blood in the market here. That's when you start buying this company slowly and accumulate. On the balance volume is a little bit lower here, and check-in money flow is also low. This happens after the earnings when companies comes down in the price. Typically, you will see a drop off in both on the balance volume as well as check-in money flow. I think this is when we have to jump in and slowly acquire and keep accumulating the stock here. And let's look at the options market here and see what options market is telling us. As you can see here, stock price for Lemonade is $52 and 52-week range is high is $188. There's a huge drop here from $188 all the way to $52. And if you look at the around $50 strike here, we got 282 open interest here. Keep watching down here. We got a lot of open interest. Look here, we got at $90 strike price. We got nice 4 634 open interest. And we also have open interest, nice 411 open interest at $140. So that's why folks are betting the stock will go higher. That's why they're buying these call options in a higher strike price. And if you look through the put options here, keep watching the open interest. There is a lot of open interest at 60 and 65. Folks are really buying the put options. Also, this typically happens, as we looked at earlier, there's a huge short ratio. Whenever you see huge short ratio, some of the folks are buying the put options, and they will make money as the stock goes below their strike price. That's what's going on here. With the high short ratio, you can expect more put option purchases, compared to call option purchase. And as you look through here from a option statistics perspective, call options traded is 6.6 thousand shares here. Look at the put options, 10,000 contracts. So in this scenario, number of put options traded is more than number of call options traded. That's why put call ratio is 1.5. That means there are a lot of people, especially short seller, betting the stock will go down and they want to profit. So when this happens, when the put call ratio is more than 1, on any good news, the stock can go higher, especially right now because their stock is down. On any good news, stock can go higher and it can squeeze these short sellers, and short seller will start covering the share and buy it, and it can make the stock explode higher. That's why I think it's a good idea right now, given there is a high put call ratio, indicating there are a lot of folks who are shorting the stock here. You could buy the stock slowly, especially because it's beaten down here. There is a good chance it will go higher. And if you look through VWAP here, because VWAP is 53, right now stock is 52.82. That tells you there's a natural inclination for the stock to at least reach VWAP pretty quickly. So with that, let's jump in here and see what should we do now. We looked at the technicals, we looked at the fundamentals. What should we do? So as you see here, Lemonade launched the Lemonade car here, and they bought this company. They announced to acquire Metromile. It's all good here. And with the Lemonade acquisition, they will get this machine learning models from Lemonade. And I think they can be successful in the car launch here. That's a good announcement. And they also drove their record $50 million net change here. That's always good. Their existing customers are also they're paying the premium nicely, and they had a great strong quarter here. In-force premium grew by 84%. That's a good story here. Top line is growing, and premium per customer is also increasing nicely here, 26%. That's always good. On the negative side, their quarterly loss is increased, and they also have a net loss here, which is almost double compared to Q3. So they have to improve the situation on bottom line here, on the loss here, and also net loss compared to Q2 was a little bit higher. I think they have to improve the situation also. And Lemonade stock tumbled the most since March here after this Metromile acquisition deal here. So overall, in summary, this company wants to disrupt traditional insurance business. I think they are doing it nicely. Right now, they are not worried about profitability. They want to grow the top line, acquire more customers. I think the stock is overly punished here. I recommend accumulating Lemonade at these levels and go from there. So with that, thank you very much. Happy investing and trading. Please subscribe.